Good afternoon, everyone. I'm Reena Aggarwal. I'm the Robert McDonough Professor of Finance at Georgetown University and the Director of the Georgetown Center for Financial Markets and Policy. And we have a panel, a session on ETFs, and this is just a tremendous panel. Before we get started, I want to thank Scott and Megan and UT Austin for putting together such an important program for our rising scholars who are going to be the future of this profession. So Scott and Megan, thank you so much for putting this together. We have on our panel here today, we have Ananth Madhavan. Ananth is Managing Director and Global Head of Research for ETFs and index products at BlackRock. Ananth has also written an incredible book on ETFs. Then we have Tim Husson. Tim is at the SEC. He's head of the analytics office in the Division of Investment Management, and obviously works very closely with ETFs. And then we have Kumar Venkataraman. Kumar is a professor at SMU, and he is the McGuire Chair in Energy Management. So he's at the Cox School of Business at Southern Methodist University. And he's written a huge amount on fixed income markets and market structure issues. He's also an inaugural member of the US SEC's Fixed Income Market Structure Advisory Committee. So we have a really good sort of a diverse panel. We have somebody from the policy world, somebody from the practitioner world, and then a scholar. So this is just terrific. I would encourage you to ask questions at any point. Feel free to use the chat feature to send in any questions at any point in time. So we're going to be talking about ETFs and assets in the global ETF and ETP industry. They're huge. They've crossed $6 trillion, and net inflows keep hitting records. So I think it's fair to say that these are one of the most innovative financial products that have been introduced in the last several decades. And they really are relatively young. These ETFs started only in the 1990s, and they become so popular amongst many different kinds of investors. There is their trading advantage, the tax efficiency, and relatively low cost structure that makes it so attractive to many different investors. I'm going to start off by asking the panel to kind of just take a step back, and I want to make sure that all our students know how ETFs work, particularly the role that market makers play, and the role that authorized participants play. How does the primary market work? How does the secondary market work? And so let's just start off with that background. And whoever wants to take that, Ananth, do you want to take that?
No, I'd be happy to. And in case you're wondering, that's the University of California, Berkeley behind me, where I teach a class. So I'm dual-hatted here. Okay, so in terms of how ETFs work, I think there's a common misconception that many people think an ETF is just like a mutual fund that trades intraday, and that's not actually quite true. Like a mutual fund, it's an open-ended fund, it's a portfolio, but a mutual fund offers liquidity only once at the end of the day and at the net asset value of the fund. The ETF, by contrast, trades intraday, and at the end of the day, ETF shares can be created or redeemed through the primary market transaction. So the ETF features both the secondary market where buyers and sellers can exchange shares of the ETF, and a primary market for keeping that open-ended structure so that the shares can be, as I said, adjust to the demand or supply.
Great. Kumar, anyone else? Do you want to add anything to that, Tim?
Yeah, I'll only add that, you know, from a policy point of view, actually, I should start by saying anything I say here is my opinion and not the opinion of the Securities and Exchange Commission or its staff, the usual disclaimer. But from a legal point of view, ETFs very much are open-end funds in the same way mutual funds are. And until recently, they were essentially just mutual funds that operated under a certain exemption from certain parts of the same legal framework that mutual funds operate in. And for that reason, a lot of the policy questions that come up with regards to ETF have this tie to the mutual fund world, and how strong that tie ought to be, how, for example, similar disclosure should be between ETFs and mutual funds, is a very hot subject in terms of like the legal framework surrounding ETFs, and that does have implications for how the funds actually operate. There was recently an ETF rule passed from the SEC's Division of Investment Management that does codify a lot of the features of ETFs that we've sort of come to expect, but that is still a sort of evolving landscape, and something that still has lots of interesting questions sort of at the frontier between financial economics and securities law.
Thank you. So, so who's using ETFs? I think it's easier to understand how the retail investor is using ETFs, but I want to get your thoughts on what about institutional investors? How do institutional investors use these products?
So we've had a number of our clients use these products in many different ways. So obviously you gain exposure very quickly. So one of the things that we've noted is that many hedge funds and active managers actually use ETFs to quickly get exposure to gold or to Brazil or to other targeted exposures. Many pension funds use ETFs as a liquidity sleeve. ETFs are also used to attain factor balances. So one may have a portfolio that's, say, a little short on quality, and you can buy a quality ETF, factor ETF, to true that quality exposure up in factor space. And then most recently, I think we've seen an explosion of interest in fixed income ETFs, where the diversification element is very large. And again, particularly in the crisis, we've seen a big uptick in terms of the demand for fixed income ETFs and ways of gaining broad exposure quickly.
And we'll definitely talk a lot more about fixed income. But I wanted to mention I was on a panel with a large pension fund manager, and it was a panel on ETFs. He was talking about how he's using these emerging market ETFs to rebalance their portfolio. And the interesting aspect was then they could use their ETFs, they could lend out their ETFs, and the lending out fee on ETFs is pretty high. So, so they could actually use their costs by lending out the ETFs and earning a lending fee on that. Let me turn to Kumar. Kumar, so obviously with COVID-19, especially I would say in that March-April period, there was a lot of volatility in the market. Right? So when we had these crisis periods, and Ananth was talking about fixed income ETFs, what happens? What happens to the liquidity, the illiquidity of the ETF itself? And then there's the underlying bonds in a fixed income ETF. So what were we finding happening with that regard?
Thank you, Reena. You have an ETF. An ETF, as Ananth pointed out, is a portfolio of these underlying securities, and you have mutual funds as well holding a portfolio of these underlying securities. So think about, three different types of securities that we are discussing here. We have ETF, we have mutual funds, and then we have the underlying securities itself. And what's interesting is that the ETF trades intraday on an exchange in the secondary market. The underlying securities also trade intraday. So if it's fixed income, it trades OTC, over the counter. If it is equity market, it trades on exchanges. And then you have these mutual funds that really allow you to trade only once a day at the end of the day. So you have these sort of three interesting securities with sort of different attributes. Now, although the ETF trades intraday, it's holding a set of securities. These securities are also trading intraday. And so you're observing the prices of these underlying securities. So you can put together a portfolio value based on the prices of these underlying securities, and that's called the net asset value. If the securities actually trade, you can observe the price. If the securities don't trade, then you may have to go to a pricing vendor like Bloomberg or somebody else to get that price. But in any event, you have this value of the underlying portfolio, that's the net asset value. So you have the ETF price, and then you have this underlying portfolio price. And what we observed during the COVID-19 period was that there was this discrepancy between these two prices, even though they are sort of representing the same thing, right? You have this underlying portfolio, and you had the ETF that was holding this underlying portfolio. You are observing large discrepancies. And I think understanding the source of these discrepancies and where exactly is price discovery occurring and what causes these discrepancies, I think is a very interesting area of research, I think, for PhD students.
Yeah, so it's it's kind of a fascinating market. As you say, there are three different products that are sort of interrelated and tied together, but yet there's actually very little research that has been done on ETFs, right? Well, why do you think that is so? Because it provides a pretty good setup with the underlying portfolio on the one side, mutual funds on the other side, and then the ETF itself. So why hasn't more research been done on ETFs? Or do people just see it as sort of the same thing as a mutual fund in terms of how this should behave? And Ananth or Tim, please feel free to chime in.
Well, I do agree that I think the academic literature has been very, very solid on mutual funds. And, of course, there's also hedge fund literature, but ETFs, I think, have not attracted that much attention. And I think it is puzzling given, I think all of the questions that, our regulators have and clients have, that there isn't more research. I think it's a great area for PhD students to work on because there are so many interesting research questions that remain unanswered. So, Reena, you pointed out the importance of the primary and secondary markets. And so, indeed, that's a big distinction between a mutual fund versus a ETF. So in a mutual fund, if there is a redemption, the fund manager must sell securities at the end of the day. By contrast, if there is an ETF redemption, the manager has the option, or the asset manager has the option to in-kind out securities. So they don't need to necessarily interact with the market. The other thing that I thought was very interesting that, again, might be a research subject was in the COVID-19 crisis, we saw ETF volumes spike, but most of that was secondary market trading. So it was basically people who were wanting to get out of their exposures and people who were wanting to take those exposures. Net, it all washed out and the market functioned quite efficiently. One could even argue that contrary to what sometimes been said in academia and in the press, the ETFs are actually a source of A, price discovery in the market, and B, a safety valve where buyers and sellers could net off without actually affecting the underlying primary market.
And Tim, the SEC has been looking at a lot of issues around ETFs. And there is some research topics that you see there. First of all, what are the issues that the SEC has been looking at? And you might want to elaborate a bit more on the ETF rule that the Commission released, because some of our students might not be aware of that.
Sure, yeah. So the Commission over the years has been, the Commission's interest has grown with the assets in ETFs, to be sure. ETFs have a number of very, very interesting research fronts that also interact with regulatory policy. Just throwing out an example that comes to mind, there are a set of maybe less than a dozen at this point, so-called non-transparent ETFs that the Commission just approved to trade in markets. And they have some unique features, such as they don't offer daily portfolio transparency like all other ETFs do. That's a very interesting feature. That's something that, as a matter of disclosure, is something that's very, very close to the SEC's heart, and so something that we looked at for a long time and something we put a lot of analytical resources into. But it's also a market that's coming to its own. And so the SEC proposed a few years ago and then just last year adopted something we call the ETF rule, which, as I said before, sort of codifies a lot of the features of ETFs that used to be done on sort of one-off applications or sort of mass applications in a sense to the SEC. So the SEC would actually review if somebody wanted to issue an ETF, their application for an exemption under the rules, because ETFs don't sort of fit into a lot of the mutual fund rules. And the ETF rule made that process a lot better. And they made it a lot more efficient for somebody to bring ETFs to market if they aren't something novel like a non-transparent ETF. It also had a couple of very interesting features. For example, it got rid of what was known as, or what's still known as, the intraday indicative value, which was basically a published intraday every 15-second metric of what the portfolio is worth. There were a lot of issues surrounding that. Those were controversial, but the SEC decided to get rid of it. Then also, it allows for something called custom baskets, which was something that was available to some issuers, but not others. And the SEC made it available to everybody, which is just a way of when in-kinding a portfolio, not necessarily offering a pro rata share of that portfolio, but customizing what they might deliver out to clients, what an ETF might deliver out to clients based on, a sampling methodology or some other method. And so there are a number of very, very interesting features, ones that we're very, very interested in understanding completely. We want to understand certainly if there's any market impacts we don't expect from the ETF rule, but also understanding just how this very unique product gets used in many different ways now that it's become such a fixture to so many markets.
Reena, may I jump in on some of the observations that Tim made? You posed the question as to why academic research has been a bit slow in this area. I think part of the reason has been some data challenges. I think it's getting better now, but in the initial stages of the market, for example, getting access to holdings data, the NAV information, premium and discount. There is a create and redeem process, as we talked about, in terms of the primary market, but there are these custom baskets, as Tim pointed out. And so information on exactly what the flexibility is when you can create and redeem a basket. There is market makers are participating in the market, these authorized participants who create and redeem. But if you look at the TAC data where this data is reported, you cannot identify the trades of these market makers. So there are many ways in which, or if you look at the data coming from FINRA's trace, you have some dealer information, but the one-to-one correlation may be difficult. I think recent research, people have been coming up with clever ways to overcome that, or they have access to better data, or they're doing using Edgar filings and things like that to collect that data. So I think we're seeing more interesting work coming out of particularly PhD students, and so research is building.
Yeah, great. I actually saw, I think, one paper being presented here at the conference today by a PhD student. I didn't get a chance to attend the session, but I saw the title was about ETFs in the primary market. I was curious, and I look forward to seeing that paper. But I should have said this before, but just for full disclosure, I do want to point out that I'm on the boards of a couple of financial services companies, and we are in the related businesses. So I just want to put it out there. Tim, you started by talking about these kind of new products that are active ETFs and semi-transparent or not transparent ETFs. And it seems like this is really going to grow. We've had, T. Rowe Price announcing they're getting in this market. Fidelity is getting in the market. So the large mutual fund companies are getting in this market. And I'm just thinking that in a couple of years, there will be some data available about these active ETFs. And so students who will be thinking about a dissertation in a couple of years, it might be an area for them to explore. But hopefully that there'll be some data available here for it. So let me switch a little bit to sort of market microstructure issues that have come up with ETFs in terms of price discovery, trading kinds of issues. And one question that comes up is, do ETFs have any kind of a destabilizing factor, or is it really the reverse, that they provide liquidity during periods of crisis, and they have a stabilizing factor rather than destabilizing? I'd be very interested in the panelists' views on this.
Sure. Let me kick that off because I've been following this literature quite closely, and it's unfortunately taken a somewhat negative turn in academia, which I think is not quite sort of warranted by the facts. So if you look at the facts, ETFs are around in the financial crisis, bond ETFs are around, it's fine. And to the point about price serving as a vehicle for price discovery, that's how buyers and sellers agreed to transact, and those were actionable prices. And I do think actually that as I mentioned earlier, far from being a source of destabilization in the most recent crisis, the COVID crisis, they were a source of basically being a safety valve, allowing exposures to come on and come off. I think where people get confused is sometimes with this mutual fund analogy, where people look at deviations of price from NAV and they get worried that the discounts or premiums are too large. And certainly we saw with bond ETFs in March, around March 20th, discounts as large as 5%. And the press commented on that, and several others commented on it. But the reality is actually that's where the market price of the bond portfolio was. The NAV may sometimes not certainly intraday may not capture exactly where you can actually trade at, because it's based on prices that were real. So I think that point is quite important, people do need to understand that the ETFs can be a source of price discovery, and you'll see that sometimes a great case study of that was when in the Greek financial crisis, when the Athens market was shut for a couple of months, and there was a Greek ETF trading, and when the physical market finally reopened, it reopened to almost exactly where the ETF had been trading at. So that's a very simple example, but it's, I think, quite telling.
And Kumar, you on the SEC committee that you are on related to fixed income market structure, are you dealing with fixed income ETFs also in that committee? And what are kinds of issues broadly in the fixed income market that you're dealing with there?
We are, and in fact, I must point out that Ananth is the chair of the subcommittee at FIMSAC on ETF and bond funds. So we have talked about this extensively within the committee, and I think it was a year ago that we had put together a report on stress markets. And if I may just take a minute, I just want to provide a little bit of the academic or the theoretical framework on ETFs and liquidity of the underlying assets. Just taking a minute. So when ETFs are introduced, ETFs are basket securities. So the idea is that adverse selection risk is lower in a basket security, coming from the theoretical concept. So you expect that the basket security would be more liquid. And if you're a bond dealer and you have an ETF trading on the bond, you can actually hedge your risk. You have these arbitrageurs who are new participants coming in, trying to correct mispricing between the ETF and the bond market. So it increases the participation in the underlying bonds of new players coming in. So these are all different mechanisms by which we think the liquidity of the underlying bonds will increase because of introduction of ETFs. But on the other hand, the concern is that if ETFs come in, a number of participants from the underlying bonds may simply switch to the ETF market. And so it means that the underlying liquidity of the ETF market might suffer. And so there have been a lot of discussions surrounding that. And also when ETF has inflows and outflows, and it results in sort of redemptions, then selling by ETFs might hurt the liquidity of the underlying market. So these are different ways in which the ETF market can hurt or help liquidity of the underlying asset. And as Ananth pointed out, in our report a year ago, we had pointed out that there was not sufficient data to actually say one way or the other, because for the last 8 to 10 years, markets have been relatively quiet. And so we speculated there that ETF could be a source of price discovery. because it trades in a better market structure. It's deeper, it's more liquid, and therefore it can act as a pressure valve. And COVID-19 in March and April just provided us with an experiment to actually test that. And more studies need to come out about it. But clearly what we saw during the COVID-19 period was that the ETF market traded quite well, particularly in the fixed income space, and that it appeared to be leading the underlying bonds in terms of price discovery. So it was providing liquidity and price discovery. And although we were seeing discrepancies between the ETF price and the underlying NAV, it may be that the underlying NAV was stale. So that's sort of the, I think, what many of us took away from the observations, but we need to see more academic studies which actually, looks at the price discovery process, the lead lag process, and shows that in a convincing manner.
Yeah, thanks.
Reena, I'll also add that one very fruitful avenue for that research is, I think Ananth pointed out a perfect example of where ETFs provide a lot of price discovery. And I think there are also examples of, for example, just very, very illiquid ETFs that have trading aberrations to them. And the issue is not the extremes. The issue is the continuum between those extremes. And so from a regulatory perspective, we're very, very interested in which asset classes work and don't work, which investment strategies don't seem to have as effective an arbitrage or price discovery mechanism to them. And so figuring out all the gradations in the very, very diverse ETF industry is something that I think could occupy a bright, aspiring graduate student for an entire career.
Yeah, and I want to just pick on Tim's point there, which is a great point. The cases that we've seen where, with some of the, say, VIX products, these are not exchange traded funds per se. They're in broader umbrella of exchange traded products. We've argued for some time that it's necessary and important to have a sensible classification scheme to make sense of this big diverse universe. So the traditional plain vanilla ETFs that are physically backed by stocks or bonds, function just fine. The challenges that we've seen that the press picks up on largely have to do with some of the more esoteric products. So a sensible naming convention, I think, is great, and some research again around the financial attributes of these different ETPs would be, I think, a great dissertation topic.
So Ananth, it's been for quite a few years, BlackRock has made this argument, and a few others have made this argument that they shouldn't all be classified as if they're one product. And Tim, has there been any movement at the SEC about thinking, how's the SEC thinking about it? Are there going to be any changes, or why is it difficult to make the changes, or why should changes not be made?
Well, I have a couple takes on that. The first of which is, a lot of this work is coming out of the FIMSAC panel that Kumar and Ananth are both on. And so that's something that we're very much listening to. But a lot of the distinctions between different types of products are not ones that are embedded in our regulatory structure. I mean, there is the difference between ETNs and ETFs. That's whether or not they're registered under the 40 Act or whether or not they're registered under the 33 Act, which means a different division within the SEC, yada, yada, yada. But that's not all the distinctions that matter. And a lot of the proposals that have come forward have been with the idea that it would be an industry-driven change. And I think the SEC, not speaking for the SEC, but a lot of the discussions at the SEC focus on, how can this be something that works for industry? Because we know that as regulators, if we're to prescribe, the classification of exchange-traded products, that's something that probably won't be evergreen, and it's something that won't be driven by market forces. And so that's at least something we're very, very sensitive to. But you're also talking to somebody who's had to explain many, many times to many, many people, oh, that trading aberration, that wasn't a 40 Act ETF, that was an exchange traded note, or that was a exchange traded commodity or something of that nature. And so it's certainly something we're aware of and sensitive to. But it does, I think, make sense for it to come from, the market.
I see, okay. I want to encourage our audience here to ask any questions, send any questions they have on chat. don't hesitate to ask as we go along. So each of you has brought up the words price discovery several times. And there's been a lot of discussion about a lot more interest in passive and index investing in the last few years, and the market moving towards that. And some, I would say very few, have questioned, is that changing price discovery of products in general? And ETFs are one way to do passive investing. So what is your take on index investing or passive investing and its relationship to price discovery?
I have an early comment on that, which is it is not the case that index investing and ETFs are synonymous. And this is a very, very important point. There are lots and lots of index mutual funds out there. And so discussions surrounding the effects of index investing on, say, correlation structure in stock markets or on liquidity or any other types of issues should take in mind those differences, to be sure. But I'll turn it over to others too.
Well, we've published a lot on this. I think there's a few points to keep in mind, right? So I think number one is the fact that when you actually look at the size of index assets, and I include mutual funds, ETFs, as well as institutional self-indexing, and so on, you get to numbers like about 25% of market cap. The rest is actively managed or is just not managed by active managers like BlackRock or one of the others. So the proportions are still small, and that's in the U.S. equity market. In foreign markets, it's even lower, and in fixed income markets, it's tiny. So but more than that, it's the money in motion, right? So the typical index mutual fund will turn over at maybe a 7 or 8% per annum kind of rate. Active managers 10, 15 times that. Okay, so they're turning over their portfolios much more often. So the amount of active money, when you add in hedge fund leverage and you add in the turnover, the amount of money chasing sort of stock level price discovery is far greater than index assets under management. So I do think that it's sort of difficult to imagine a situation where flows into index funds are somehow hurting price discovery. The other point is a very simple one, goes back to Sharpe in 1991, and basically it says that, look, the index funds look a lot like the market. Index funds plus the active funds look like the market. Therefore, if there are flows from active to index, it flows from something that looks a lot like the market to the market itself. Basically, these are price takers, not price, not distorting prices, and certainly not impairing price discovery.
Yeah. So Kumar, this is. Has there been any research done around this topic? Because it really seems like an empirical question that should be answered empirically, and I can see if BlackRock makes the argument, then they might seem a little bit biased, but we in academia have the responsibility, right, to address these questions and whatever the data says, bring that out and put it to rest. So we haven't really seen much. You're muted, Kumar.
Yeah, sorry about that. Yeah, I think it's a really interesting question. I think there is some work that is coming through, but I don't know if the evidence is very clear one way or the other. So one thing to keep in mind is sort of the arbitrage risk, right? If you have to correct mispricing, you have to take a large position, and if you feel that there is a flow coming in that's moving prices in a particular direction, then you may just hesitate to take that position until that risk is minimized. So I think those are some of the mechanisms that are in play here in terms of what would be the threshold where we see that problem. Reena, I wanted to make a related point on what Ananth talked about, which was turnover. So, and this is something we've talked about in the fixed income market structure committee as well, which is that, as Ananth pointed out, in the case of indexing, you're trying to get passive exposure to a portfolio, right? And you want to do a buy and hold investing. And there is one really interesting distinction between implementing that strategy in the case of equities versus bonds. In the case of equities, if you're looking at the S&P 500 index, the turnover is very low. As Ananth said, it's like 5% per year. So you can largely practice a buy and hold strategy. But if you take the most prominent bond index, the turnover is almost 40% per year, which means that 40% of the portfolio is really rolling over. And when bonds get dropped and added by these index providers, the underlying funds that track these indexes also trade by buying or selling. That results in a lot of correlated flow hitting the market at the same time. That results in dislocation. So the passive strategy and the cost of implementing the passive strategy, I think, is different across asset classes depending upon the attributes of the security. So you have bonds, they expire. You have new bonds that are issued all the time as firms roll over their debt. And so I think this is also an area where PhD students can contribute, I think, if they're thinking about research ideas. What is the right way to construct an index in the case of a bond market versus an equity market? Right now, we have a very mechanical approach to constructing a bond index, I think, just following the equity markets. But I think things can be done in a more perhaps sophisticated way. So I think that's an interesting idea. And what are the costs of actually implementing a passive strategy in the case of fixed income? It's not clear to me that it's the same as what we have learned from the equity markets. So again, just some ideas that I wanted to throw out.
Yeah. So we have a question I want to pose to the panel, and let me just add my own color to it. The question is really, are there funds that are going to move from mutual funds into ETFs? And now I'm going to tie the question along with my own question. So now we're going to have, for example, we have active ETFs that are coming out of mutual fund houses, big mutual fund houses. Is the pie going to get bigger somehow, or are we going to see more funds moving out of mutual funds and into ETFs?
Well, I think a lot of asset managers look at the ETF structure as being very efficient for certain kinds of investors. So obviously, if you're putting, say, $200 a month into your fund, then trying to trade $200 is a little tedious, and you may pay some commission costs. The mutual fund structure is better. But for most investors, the tax advantages of mutual funds or tax advantages of ETFs are there over mutual funds. And so it may be a more efficient structure for the asset manager to migrate an active mutual fund into an active ETF. So I'd expect to see more of that taking place now.
Okay. And Tim, there's another part to the question which I'm going to pose to you. And the question is, how about the 2018 reforms for mutual funds that allow swing pricing? Will that make mutual funds work better during stress periods?
Well, potentially. I think there's a lot more history in Europe with regards to the actual usage of swing pricing. They've had that available for a lot longer.
Can you explain swing pricing for the benefit of our audience here?
Yeah, so the long and short of it is that it's a way to modify the net asset value that somebody will get upon redeeming their shares to reflect the trading cost that it would take to actually redeem those shares, out of the portfolio, that part of the portfolio. And so it's a way for those investors leaving mutual funds to take on some of the costs that they impose on other investors by those redemptions. And it's something that is, like you said, it's part of a recent rulemaking called the liquidity rule, where the SEC basically said that up to a limit, I believe it's 2%, funds can implement swing pricing. They have to have policies and procedures, et cetera, et cetera, et cetera. Now, I think one thing that's very interesting is, in the recent crisis, I don't believe any funds used swing pricing. And that kind of information is disclosed on Form NSEN. It's also something we've asked a lot of firms about. a lot of their reasons behind it. And I think that that is itself a very interesting question, why firms might be reluctant to use swing pricing even in pretty extreme market conditions, but then why in the European case, there is more of a history behind it. So I'll actually just leave it as a research question, one that we're very interested in, which is swing pricing the right answer to that problem? If it's not, what is the right answer, and what might be the reluctance to implement it in the United States?
Very interesting. So this is a question for anyone on the panel. We've talked about innovations coming in the ETF market, for example, active ETFs. Where else do you see changes, innovation coming in this market? Yeah, Ananth, did you want to say something?
Yeah, I'll jump in. I mean, I think we've seen a really big surge of interest in ESG investing. So I think there'll be a lot of ESG growth in assets and ETFs. I think the other thing that's coming is sort of greater awareness of factor investing and interest in factor investing, using ETFs either to true up factor exposures or to build a factor position. Fixed income, we've mentioned a couple of times. I think the interest in fixed income ETFs is very real, and that's an interesting intersection because the market is so, as Kumar said, so opaque and so dealerized. It represents a challenge for managers to acquire large amounts of bonds quickly or to dispose of large amounts of bonds quickly. So there's room for innovation there in terms of combining electronic trading and fixed income with the ETF creation redemption mechanism. And there's also room for, to your earlier questions, Reena, about active ETFs, room for fixed income ETFs that take advantage of certain pockets of liquidity and avoid certain other pockets of illiquidity. So in other words, one can imagine using optimization to build portfolios that closely resemble broad aggregates of fixed income or sub asset classes of the fixed income market, and yet at the same time overcome some of the challenges that Kumar mentioned in his earlier remarks with high turnover. So those are all exciting avenues for future ETF innovation.
So just going back to active ETFs, is there quite a bit happening on the fixed income side, or is it mostly focused on the equity side right now?
The asset growth is coming from the fixed income side, but the new products are coming from the equity side, and that includes the non-transparent products that I mentioned before. And so it's early days when it comes to active equity strategies, and I think that's for reasons that make sense in terms of the portfolio disclosure issue that led to the non-transparent ETFs. But the phenomenon of actively managed fixed income ETFs is not old, but it's one that's been with us for quite some time, for a number of years, and it's been growing at a pretty considerable rate. And so I think it's already starting to split off into different sort of segments, and that reflects a lot of different use cases.
Tim, I think this question is for you. It's coming from Chester Spatt, and Chester's asking, had many funds already established policies and procedures for swing pricing by March 2020?
I forget exactly how the disclosure is worded. I believe it's difficult for me to say across the entire board, because I think the only information we have is related to actual usage. So I'm not sure that I have the answer for you. I know in the conversations we've had, a lot of fund shops had not even considered it, or they had considered it, but they had not put in place any policies and procedures to actually take advantage of it, or those were their sixth line of defense on the issue. It was just not something that was front of mind for a lot of fund shops. But again, I can't make generalities, but that's based on the conversations we've had.
I see. And then Chester is also asking that given that there was no take, and assuming that these policies and procedures had been established, Should the SEC mandate swing pricing to mitigate risks during periods of crisis?
Of course, I can't speak for what the SEC ought or ought not to do as a noble staffer. But I do think this is a very important issue, and it's one that's sort of at the heart of the regulatory landscape around funds generally. And so I think it's something that deserves people like smart, enterprising PhD students to tell us what the right answer is and where the answer works and where the answer doesn't work. I think figuring out those nuances will be very, very important before the SEC takes any action, like mandating something that the entire fund industry ought to do. And so I think that the information needs to come from all of y'all. I think we need to do those analyses. We've got some empirical sources now that are very, very rich. And when you get the answers, we'll be listening because it's something that's very, very important.
May I jump in with an observation, Reena, on swing pricing? So it was very striking to me because a few years ago, you may remember, E.T. Goldstein and co-authors, they had written this paper about the problems with portfolios that have illiquid assets where the prices are not updated as frequently. So if you are an investor along with other investors in this portfolio, and you know that the market has dropped 10%, but these prices have not been updated, it's better for you to get out first because you can get out at a loss of 2% rather than 10%. So it leads to this first mover advantage. And E.T. Goldstein, who I know was in the editors panel earlier today, and co-authors had written this JFE theory paper on this. And when you looked at what happened in March and April of 2020 and the press descriptions of what happened, that's exactly what happened. There was an first mover advantage, and so there was outflow from certain funds when you had the significant correction in March of 2020. And I remember sending ETA in an article which seemed as though this was somebody from the industry writing his model and talking about it in an applied way, which I think is really cool. If theoreticians can, write models and then it shows up exactly during a crisis. So I think it's really important, particularly during periods of stress. Perhaps in those times, you might even consider whether the liquidity considerations are high enough or whether you need to protect investors and maybe stop redemption for a period of time till you figure out the pricing correctly, because somebody is getting out at a higher price and some investors may be getting in at a different price. Thank you.
Maybe if I could just weigh in just slightly. So it seems to me the economics of this, in the spirit of Itai's paper, are very much like the money market fund issues from the financial crisis. So it seems like in some ways it seems like a no-brainer, and it seems to me like the funds ought to have responsibility to use pricing that is fair, taking this into account. It doesn't seem to me there's much downside, except unless the funds don't know how to do this. Anyway, that's just some more thoughts on this.
Thanks, Chester. And so, Tim, which form did you say the funds have to disclose this on? You're muted, Tim.
Oh, sorry. Yes, I was using the jargon before, which I should never do. There is an annual form filed by all registered investment companies, so mutual funds and ETFs, that's called NCEN, like the letter N, and then CEN is in census. And it provides a lot of information about the service providers and the operations, other details about fund, including some related to whether or not it's used something like a line of credit or swing pricing or securities lending. It's a sort of underrated form, in my opinion, and so one that has a lot of very rich data. It's been filed with us since, I want to say, early 2019, but maybe it was 2018. There's another form, which I'll also say is a new and potentially rich source of data for enterprising smart PhD students, which is Form NPORT, which is the letter N, and port is in portfolio, which is the quarterly holdings of all mutual funds or ETFs. And that is a very comprehensive data set that is available publicly on the SEC's Edgar website. And so that is something that can, I think, very, very much assist the the discussions and research around mutual funds to be sure, but also ETFs.
And so ETF holdings data one can get from Nport.
They can, although ETFs do disclose their portfolio information more frequently, but they usually do so like on their fund websites. And so it's in a less standardized form. But if you're looking for a comprehensive view sort of across the industry, Nport is an option.
That's a great point. And I just want to throw out there for PhD students who are interested in doing research on this, natural questions that are interesting to both academics and practitioners concern crowding. So some research I did was it's a paper with Andrew Ang and my colleague Alex Sobchik, which is to say what happens when there are more funds than stocks. So there are roughly about 3,000 stocks that are traded in the US. There's something like 15,000 funds. And we can then look at it with the principal components kind of analysis and see, are fund positions getting more alike or less alike? And is it different from ETFs versus mutual funds? Those kinds of questions I think are really super interesting and could be done using Nport.
Yeah, this market obviously continues to grow, and as it continues to grow, there are more questions, there are more products, and there are more regulatory, policy-related questions, and the market is interested in these issues. So there's definitely a lot more that needs to be done. We have just a few minutes left. If anyone has a question, please feel free to submit or unmute yourself and ask. But any last words of wisdom for our PhD students here? Kumar, you've been a scholar for many years, a wonderful scholar, very successful. What advice would you give to the PhD students working in areas? And broadly, ETFs or fixed income market or market structure issues, whatever.
I think the last few months has really provided us with a new environment where a lot of the theories can be tested. We've had new instruments and new players, changes in institutional detail and market structure over time, but for a very long time we've had markets that were quiet and the level of uncertainty was low. So going back to some of our theories and looking at the more recent period and seeing how the theories play out, I think is provide many interesting empirical patterns.
Okay. Anyone else? Ananth, you are in the private sector, but I really think of it, you as an academic also. You've certainly had that life and continue to have it.
Yeah, well, I crossed the Rubicon some years ago. It's now spent more time in industry than in academics. But I will say the price discovery idea came up a few times. And again, I want to suggest something actionable for the students on the call, which is there are really three values to keep track of in ETF land. So there's the price, which is determined on an organized lit exchange where buyers meet sellers and agree on a market determined price. There is the net asset value of the fund, which is produced once a day at the end of the day by pricing provider. And then there's the unobserved intrinsic value of the fund, which you do not see. And that intrinsic value can be estimated a number of different ways. You can go bottoms up from the constituents, or you can go top down using some sort of state space econometric technique. We've done it both ways. Again, in the paper with Alex Sobchik, which was published in the Journal of Investment Management, we did a state space representation. Then you can actually test theories about price discovery, which asset classes is their price discovery, how quickly does arbitrage work to correct price deviations from intrinsic value, those kinds of things. So I think that's an area that's very important to regulators like Tim. It is very important to academics. It is very important to practitioners. I think the more research that's done on this, the better. So I'd say that that's again, an actionable area where you do not need a lot of data that is difficult to get or impossible to get. You can actually go to public sources and get all the data.
Well, we have a question from Yelena, and I was mentioning she's the one who had presented the ETF paper earlier today. And her question is, so exchanges have in place incentive programs for market makers to provide liquidity in a continuous fusion. ETF's creation redemption mechanism is purely market arbitrage based at the moment. Does the SEC consider any possibility of allowing the ETF issuer to incentivize APs to be more active?
Well, again, I can't speak for what the SEC can or should do. I will say that the issue of an active, diverse, authorized participant landscape is one that we pay a lot of attention to. It's one that we didn't have a lot of daylight into until Form NSEN. NSEN actually has funds disclose who their authorized participants are and how active they were during the last year. And that's a very, very rich set of data. It's one that the early result on was there is actually a very diverse landscape of authorized participants in most funds. That's a good thing. So that's something that we very much pay attention to. We want to be sure we know if APs are ever incentivized to sort of step away and not, affect the arbitrage mechanism. But there is a distinction, of course, between market makers who keep the security, liquid in the course of the day, and the authorized participants who actually engage with the fund in transactions. And because of that, there are a lot of both regulatory and other kinds of nuances to work out. And so I'll only say that the issue is pretty complicated, but it's something we're sensitive to in that we want, I can't say we want, but it is generally considered a good thing for there to be a diverse and active AP community, even in very small or esoteric products.
Ananth, do you have any comments based from your perspective?
Well, I mean, I think just one to correct a little misconception, which is not all the creation or redemption activities is arbitrage related. So, for example, sometimes a large hedge fund wants to take an exposure. It's going to be a huge impact. They go to a market maker or to an AP and say, we'd like to have a creation, and a creation is done. It doesn't necessarily mean there's an arbitrage opportunity. The second point is that it's not just the APs that might engage in primary market activity. So a hedge fund may think there is a actionable deviation and may choose to go to an AP who basically is renting out their pipes. So only the authorized participant can create or redeem ETF shares with a particular ETF issuer, but that's not to stop a hedge fund going to the AP and saying, we would like to do this transaction with you. And basically they will do it for, the fee that they charge.
Okay. Well, that was our last question, and this is the last session, and we're approaching our time here. I want to thank Kumar and Ananth and Tim for a fascinating discussion, and thank you again to Scott and Megan for putting this conference together. And thank you all of you, and good luck with your programs, your dissertations, and look forward to having you in the profession.
Okay, thank you, Reena, for moderating.
Thank you, Reena.
Thank you, Reena.
Yeah.
Yeah, stay well.